Hi, everyone. I'm Owen Spedding, Manager of Bureau Alliances at VantageScore. Thank you for joining us today. This webinar is specifically geared towards supporting lenders through changes that are occurring in the conforming mortgage space. This is the second in a planned series of webinars on the topic. We are updating lenders as developments arise, and I hope you find them useful and a concise way to keep abreast of the changes. Our October webinar that provided much of the background to the changes is available on VantageScore.com. If you go to the lenders and fintechs section of our site, it is available under the company menu on the events page, also under industries we serve menu on the mortgage page. In recent weeks, the FHFA has held 3 stakeholder forums. The topics have included the historical data sets that many lenders have been waiting on to help bridge the previous credit score process to the new credit score process, and an update on the key implementation milestones. We will also outline the options available for piloting VantageScore prior to the FHFA's implementation. If you haven't yet crossed his path, our presenter today is Tony Hutchinson, Senior Vice President of Industry and Government Relations at VantageScore. He brings nearly 30 years experience and wealth of knowledge about the inner workings of Congress and the executive branch, as well as a deep understanding of the housing industry. Prior to joining VantageScore, Tony was the Director of Government and Industry Relations at Freddie Mac. We have the Q&A function turned on in this webinar, and if you have any questions, please enter them there, and I'll ask Tony at the end of his presentation. So I'll hand you over to Tony to provide an overview of recent developments. Thanks, Tony.
Thank you, Owen. Thank you, everyone, for joining VantageScore for our second update of FHFA's new phase in the implementation of the new credit score models. I only have you for a very short period of time, so I'm going to try to make things as efficient as possible and go through a lot of information that has come out over the last 2 stakeholder forums. But what I do want is for you to get from this presentation, there are 3 things that I think you should definitely take away. First, the implementation process is moving forward. That's number 1. There is no slowing this down. Things are beginning to move forward. 2, FHFA and the GSEs, Fannie Mae and Freddie Mac, are actively listening to what industry participants have to say about this process. They're listening to concerns, and they're actually soliciting solutions from the industry for some of the concerns that are posed. And I'm going to point out a few of those as we go forward. The last thing that I want you to remember is that VantageScore is your partner in this transition. We're here to help you with anything that you need in terms of getting to know VantageScore 4.0, working to help you with your credit reporting, credit score provider to get the information in-house so that you can begin to analyze the data, as well as do any level of training with your loan officers or credit risk personnel on the product. So again, we're here to help you, and we look forward to speaking with you guys afterwards on this way as we progress down this journey of implementation. Before we get started, I just want to review quickly the agenda that we're going to be talking about over the next 30 to 40 minutes. 1, I'm going to recap how we got here to make sure that we're all set levelly, understanding how we've come to where we are right now. Then I'm going to go into the 2 discussions that have occurred to this point, the historical data set forum discussion, and then the implementation milestone discussion. And then finally, as Owen mentioned, I'm going to talk to you guys about ways that you can implement VantageScore right now. And I'm going to show you a couple of illustrations that reiterate the point that I'm going to make. Hopefully that will shine a light on some potential opportunities out there for you. So we can go ahead and begin. Next page, please. So how did we get here? As all of you all know, or most of you know, back October 2022, FHFA, after a lengthy period of time analyzing the new models that were presented for possible adoption by the conventional conforming space, made an announcement that they were going to allow FICO 10T and VantageScore 4.0 to be the models that Fannie Mae and Freddie Mac use in the secondary mortgage market. Obviously, this is going to cause a significant change in the marketplace. Anybody who sells to them will have to utilize the new scores. Next page, please. Within the last year, since that announcement, FHFA has undertaken a lot of work to understand where the market is, what their concerns are, sharing with them as much information as possible about this process. They've brought resources to the market. They've shared a playbook about how this will be implemented. Both GSEs have that on their site, and it's updated regularly. And they conducted a number of education sessions throughout the marketplace to make sure that everyone is on the same page and prepared to move forward. Next slide, please. And where we are right now is this new phase of implementation where there are FHFA and the GSEs are outreaching to people like you, your organizations, to give them input into this process. Specifically, what they want to know is, what are your concerns? What are some of the things that are making you stay up at night? What resources will your organization need in order to facilitate this change in the marketplace? One of the things that they heard was that people needed historical data, and that's what they've been working on. So as we begin the discussion now about what has transpired, all of that information, everything that people have said to this point, they've taken into consideration, and now they are ready to really begin the process of implementation. So where are we in the timeline? Let's take a look at where we are in the timeline. Next slide, please. So 2023 is coming to an end. FHFA has pretty much hit all of the milestones that they placed for 2023, with the exception of publishing traditional credit score historical data as it relates to the tri-merge, bi-merge transition. They have delayed that. Part of the reason that they delayed that, and we mentioned this the last time, is because they've only begun the discussion about what historical data they are going to provide to the marketplace and how big of range that data set will be. So they've delayed that fourth quarter deliverable. It's not going to occur in 2023. It will occur sometime in 2024. They've not provided a new date for that. That's why it's said to be delayed. But all the other milestones in the timeline remain in place, including the utilization of the new credit scores come third quarter 2024, with the final with all of the credit scores being implemented in fourth quarter 2025. Next slide, please. So what does all this mean? This means that FHFA and the GSEs are continuing to move forward, as Director Thompson has mentioned. They are continuing their outreach, but in their minds, and what they are conveying to the industry is that they want to continue to move this process positively down the road. The one caveat that I will mention in this before we get into the historical data sets is the timeline as established is to give the industry markers to focus on for completion. If as an industry, we come up with obstacles and solutions that take a little time to implement, then the timeline potentially could be extended. But FHFA and the GSEs have made it perfectly clear that they do not want to extend or delay implementation without fully understanding what the obstacles are and how long it will take to implement them. That is why they are having such robust conversations with the market about concerns, issues, how they should proceed, how the market should handle the implementation of the new credit score models and the tri-merge to bi-merge transition. So let's get into that. Next slide. The first meeting that occurred was on November 7th. It focused on historical data. And there were two things that FHFA wanted to share with the over 400 participants that that showed up for that forum. The first thing they wanted to do was discuss how much data they are going to make available to the market. The second thing they wanted to do was demo the click-through process of acknowledging the agreements that everyone in the market will have to adhere to in order to utilize this information. And the two agreements that were clicked through were for VantageScore 4.0 and then the FICO product. When you go to pull those data sets for that historical amount of information, each one of those is going to have to be positively acknowledged and agreed to in order for the information to be made available to you or for you to access it after you've gone through the click-through. The first thing I will share is that FHFA plans to make a decade's worth of information available via the GSEs to the marketplace. That's 10 years, from 2022 all the way back to 2012. 10 years of data available to the marketplace with a VantageScore 4.0 and a FICO product, the new 10T product associated with the loans in that data set. That will be available to each and every business that wants to download it once they click through and accept the agreements. Next slide, we'll talk about what members or attendees of that event had to say about that. So the one thing to hear right off the bat is most people wanted a longer data set. That's been something that the industry has asked for since the beginning. Currently, the data that most people utilize goes back to 1999. That's the biggest data set that they have. And the reason that they want that large data set is because they want to see how the scores are going to perform over a number of different economic cycles. There were downturns in 2000. Obviously, you had the Great Recession in 2008 to 2012. You also had the pandemic that we just went through, and everybody wants a data set that shows how that Black Swan event, the pandemic versus the Great Recession, how the scores perform. Unfortunately, trended data does not go back past the Great Recession. So the data set that FHFA is going to provide is a decade's worth of information that goes right up to the end of the Great Recession. And we're going to talk a little bit about that because there was some conversation in the in this forum about that length of time. The other thing that came out of that conversation was that people, when they get the data, regardless if it's the 10-year data or if it goes all the way back to 1999, if they figure out how to do that, the one thing that everybody said that they need is an extended period of time to analyze the information so that they can make adjustments to their risk models, so that they can understand how it's going to perform, so that they can make any changes necessary to any of the internal tables and internal analysis that they have. Consensus was, at least by the people who shared their responses, is that a year and a half, about 18 months, was required for that analysis. So we need more data, a longer period of data, and we need time to analyze it. That's what the industry was saying during this forum. Now, the thing that was really interesting about that were a couple of things. There were some questions that popped up first about the length of time, or the amount of data that would be provided. There were a number of folks who said, we recognize that the data set is only so big, mainly because the credit reporting companies don't have trended data that go back past the Great Recession, or at least not all of them do. One of them may, and one of the questions that came up and is currently being entertained by FHFA and the GSEs is if one of the agencies, credit reporting agencies, has trended data that goes back past the Great Recession, is it possible for the industry to just take a look at that one? Obviously, that gets away from the whole data sets that were used in a tri-merge, but at least people want to be able to see it. So that's something that was suggested that is being considered. Another piece of information that was being pushed, or another suggestion that was really getting some traction, is the idea of smaller sample sets being provided to the marketplace now, as opposed to the entire 10-year data set. During the conversation, the GSEs mentioned they're still pulling that information together. It's taking them a little bit of time, aside from getting all of the agreements that they need to in place in order to make that available, which they pretty much have now. They're still pulling all that information together and trying to figure out what makes the best sense to push such a large data set out so that the industry can use it. Some members said, can you give us right now, so we can begin that analysis, a smaller sample set? It can be a random sample of any of the loans within that data set, or it could be just 1 year's worth, so that one, they could begin to analyze it and see what it looks like. And then two, they can figure out, how can we get it into our system? Does it make sense to the way it comes out to fit in our models? It becomes a bit of a test so that they can make sure that when the more robust data set comes out, that they're able to ingest it and analyze it. So that's something else that FHFA is currently considering. It was a great suggestion that was made by one of the participants. Another piece of information that came out that was really of interest, and now they're thinking about this because they were not in the beginning, is how to provide the information in such a way that you're not just getting a point in time, meaning that you're going to get 10 years worth of data and you'd have scores possibly just at origination. Some folks mentioned that in order for this data set to be extremely robust and useful to the marketplace, you needed to be able to have some refreshed time periods so that you could see how the loans have performed over time and how the credit scores have changed over time. So they're now thinking about that. Again, that may play into whether or not they offer a smaller data set for people to begin to use right now, because that might be something that's easy to put out, easy to refresh, so that the industry can begin to understand the information and digest it. One of the last things that came up, and this is a theme that you'll also see come up in the milestone meeting, is this idea of a safe harbor. A number of folks shared that as the GSEs are contemplating rules for utilizing 2 credit scores, and those rules are still up in the air. Some people have talked about averaging scores. Some people have talked about utilizing 2 scores together and having a table like that. Those rules are still up in the air. There are some in the industry who are fearful that existing fair lending laws will not be adequately addressed by these changes, at least in the beginning. So they want to make sure that lenders in the marketplace, and they've made this perfectly clear to FHFA and the GSEs, they're looking for a potential safe harbor to protect them as they are moving down the path of implementing the new scores and using them. I will share that FHFA indicated that they are not in the business, and they aren't as an agency, of creating safe harbor legislation. So that is something that industry participants are going to have to work with Congress and potentially with their trade associations to get done. But they did not say that it didn't make any sense and that they were not supportive. But they did take that information in-house, and they're actively thinking about how they may be able to assess the need for it and if they can help the industry with that. So that is the data set conversation. The one thing that I will mention is FHFA has kept these forums to 1 hour. They want them to move. They want to share their information out there. They aren't leaving a whole lot of time for debate. And before they started this, they said that there would be no relitigation of their decision. To this point, I will say that all of the participants have remained true to that. And all of the information that they're sharing, as well as their concerns, are not about whether or not FHFA has made the right or wrong decision, but whether these changes can be implemented easily and if they make sense. And they've been sharing very good information with both the GSEs and the agency about that. So they've been very constructive. I would suggest that if you have not participated in those sessions, that when the next 2 sessions are posted, you should participate in those. So let's now move on to the implementation milestone recap, which was held on the 14th of November. Just like the first one, this one was extremely well attended. Over 340 participants offered or participated in this session, with 14 people or 14 organizations offering comments during the section, all of them constructive. In this session, and we're going to go through these very slowly, it was a little more complicated than just talking about the data set that was going to be offered in the original session and showing a demo of click-through on the agreements. In this one, FHFA and the GSEs offered options for implementing the tri-merge to bi-merge transition, as well as the credit score model update. They offered a couple of options out there that they wanted to get some feedback on from the industry. And to say that the conversation or that these options didn't spur robust conversation is an understatement. But the information, the feedback that was provided was well received and extremely constructive. You can go to the next slide. So what did they talk about? What were these options that were provided? So there were 4 options that were provided in totality, but they broke them out into 2 sections. One, they wanted to talk about the tri-merge to bi-merge transition. And that they just wanted to know, did people think that the transition should occur prior to implementing the new credit score models? So do them separate. Option B would be just make the transition simultaneously, effectively as it is written out in the current timeline. That was the first set of options that were presented. The second set had to do with the new credit score upgrade. They wanted to know, did you want that phased in? A la what they're talking about right now, where you would at one point use all 3 scores, get an understanding of their interaction with the marketplace, and then phase out the old score, keeping the 2 that have been designated for the conventional conforming secondary mortgage market moving forward. Or option 2, you would just go cold turkey at one point, meaning that at some point in time along the timeline, you would stop using the traditional score and then automatically move to the new scores. Those were the options that were presented, and some robust conversation occurred right after those conversations those options were presented. The first thing I'll talk about is the issues that came up about the tri-merge to bi-merge conversion. So the primary themes that came up, and we've heard these before, but they were explained very well to the marketplace. And I know FHFA has taken these back along with the GSEs and are now trying to find rules around some of the issues that were brought up, as well as I'm sure that during the next conversation that occurs on this, they're going to push out some questions to the marketplace about suggestions they have for getting over some of these obstacles. The first thing that was shared with the marketplace on this is a concern around gaming the system. Meaning if you have an opportunity to only pull 2 scores versus 3, even though the GSEs have indicated that if you pull 3, you have to submit 3, there was some concern around soft credit pulls, where lenders could potentially take a look at all 3 and then decide on the 2 that they want to use. And some folks thought that that could be a detriment to the market, and they shared their rationale why. Within that rationale was the fact that each of the credit reporting companies have differing information in the credit reports. And the industry wanted to know from FHFA and the GSEs, if we make this transition and we do come up with rules about gaming, how do we handle the difference of information in the different reports? The reason for that, and all of this is stacked, that's why I have them in my slide, is because there is concern that two things could occur if you don't use the tri-merge, and that is that differing of data could be more expensive for some consumers out there if the report that has the best data for them is somehow not used, meaning the loan origination process becomes more expensive for them because the cost of lending becomes more expensive. The other piece, and this goes right back to that safe harbor, and I said this had that safe harbor issue just will permeate this for a minute, specifically on the transition from tri-merge to bi-merge. If information from two of the credit reporting companies spurs a denial, but a consumer or someone else can see that the utilization of a third credit report would have been enough to move the needle so that the person could be approved, then how is that handled? Now, the first question that comes to mind is, if it was gamed, why would you not use the scores that were obviously advantageous to the consumer? That was something that came up. But the key is, say, for instance, you as a small lender or you as a lender just decided that there were two organizations that you wanted to use, and those organizations didn't give the information that would have given an approval, but the consumer found out that the other, how do you protect yourself against that? That's where the safe harbor comes in. And those are the obstacles that are really being presented and are being thought of now by FHFA and the GSEs. I would suggest that as the next session comes up on this, and we're going to recap that as well, that either before or right after, if you have any ideas about how you handle that situation, you go ahead and share those with FHFA. They have set up a email address and a web page for that information to continue to flow. They do not expect the industry to share with them information just at these forums. They do want that information to continue to come in. What were some of the other issues that popped up with the implementation or the transition from the tri-merge to the bi-merge related to the milestones that have been established? A big question was, has FHFA and the GSEs reached out to the government agencies, FHA, VA, USDA, and made sure that they are on board with the changes that they are making? The big concern is that you would have a bifurcated market, a market where half of it, or the portion that goes to the government, utilizes a different credit score model and a different standard from a tri-merge to bi-merge perspective, and then one that the conventional conforming market puts in place. A lot of folks have indicated that that would cause them financial hardship and issues, meaning that they'd have to maintain two separate systems, follow two separate sets of policies, which would be confusing, and then not able to pass on information seamlessly to all of the players in the marketplace, including end investors. So that's something else that is being considered. And then finally, a question that was almost, I don't want to say it wasn't deemed important, but it came at the end, and everyone had the same aha moment when it was mentioned. And this is, how are you going to educate market participants, number one, about these changes? But more importantly, how do you make sure that the consumer is educated on this process? That was a big point of conversation. A lot of people are extremely interested in who is going to be responsible for that. Will that be the GSEs offering that level of information? Will that be FHFA? Are they going to have to engage the industry, and how? And what will that look like? Great questions, and that were posed by the industry. Great things to think about. And FHFA and the GSEs are now building out solutions and requesting information from the industry on these. we can move on to the next. Some additional feedback around the implementation timeline was that a lot of the larger lenders liked the all-in approach that was mentioned, meaning that you would go at one point in time, just stop everything you're doing and begin the new regime. It was mentioned that they thought that that could shorten the actual implementation time frame and make things a little more efficient. Now, that did not go over well with a lot of people, but that was something that was mentioned. The other approach that people said that another reason that they said they like the all-in approach is because many thought that a phased approach would cause issues in the marketplace, specifically around pricing loans. If for a while you were using 3 credit scores or pulling 3 credit scores, you would need definitive rules about when the new scores would come into play, when the old score would only be used for pricing or not used for pricing. So they wanted some more specificity around that, so there'd be less confusion in the marketplace. Again, the big issue, another one of the issues that came out of this idea of having that phased approach was that one of the things that FHFA was hoping to solve for by offering competition, and that is the movement from the tri-merge to the bi-merge, is that you would reduce cost in the marketplace. A lot of folks have indicated that even with that transition, you are adding more credit score pools to the consumer, which will cause more cost to occur for them. So they wanted the industry to be cognizant of that, or the FHFA to be cognizant of that, and determine how they could help with that, or put rules in place or process in place that would cause the least amount of harm to the consumer as possible. And just like on the prior slide, when they were talking tri-merge to bi-merge, wanting to make sure that the government was on board, for the credit model upgrade, they wanted to make sure that the capital markets groups, the investors, were fully on board and up to date on what was going on. They wanted to make sure that when they go to market with mortgage-backed securities or with specifically on their own, outside of going through the GSEs, that the marketplace was up to speed on the utilization of the new credit scoring models. Now, I can tell you, on the VantageScore 4.0 side, the market is really up to speed on our score, not in the mortgage space, but in the asset-backed security space for auto, credit cards, and consumer lending. We've been out in that space for an extended period of time, and we continue to grow. So investors will understand the score, VantageScore 4.0, from an capital markets perspective, just not on a mortgage markets perspective, which means that there will be some level of education that is required. And FHFA has taken that. As we move further on, there were some suggestions that came out of the discussion that were really interesting. And I'm going to start from the bottom of this page on up. And one was, they wanted to make sure that the transition that occurred from LIBOR to SOFR was the same transition that was utilized as we go from the tri-merge regime to a bi-merge regime and to the new implementation of the credit scores, meaning that there was a lot of communication with the market, constant communication between the regulator, the GSEs, and the marketplace, and that communication was two-way, that any changes that were being made and the rationale for them were being shared with the market. Any concerns that the market had and the rationale for them was being shared from the market to the regulator. And collaboratively, just like with LIBOR to so forth, they were coming together to find solutions so that implementation could take place. The other thing that came, and I'm going to talk a little bit more about this specifically on the back end of this slide, is the idea of piloting the use of the new credit scores. A number of lenders said they would love to see a sandbox, if you will, created for them to bring in the new scores at origination and to monitor their performance. Also to test, one, getting the scores into their systems, but also pushing them out to the GSEs, which would allow the GSEs to now play in that sandbox around pricing, to test pricing, their pricing models, as well as intake of their information. Someone even suggested to maybe bring in one or two external investors to make sure the systems work there and that communication flows. That was something that was very well received. It was specifically promulgated by a smaller financial for smaller financials so that they could get themselves up to speed and have a place to work. But it did resonate well with most people that were in the session. So that is something that is being contemplated. The other thing that was offered that was really kind of interesting is a tiered approach to implementation of the new credit score models. And that is to have those people who are ready right away, those participants, be they mortgage originators, mortgage insurers, or anyone else in the space that utilizes credit scores, if they are ready right now to use it, allowing them to migrate and upgrade their models now. And then as other folks are becoming ready, giving them time frames in which to get ready and then turn on the switch. So that's something else that is being thought about right now. So I know I said I was going to keep you guys for a little bit of time, and I've kind of gone over that. But what I want to do now is talk a little bit about some opportunities that I think make sense, specifically as they relate to the whole idea of piloting the products. We have been big advocates of adopting early VantageScore 4.0 so that your organizations can better understand the score and how it will mesh with the products that you offer. A couple of things that we have been recommending. One, to pull the scores now at origination. This allows you an opportunity, even though you aren't delivering the scores right now to the GSEs, to test your systems to see if you can get them in on a flow basis and work with your credit reporting company or credit score provider to figure out how to interact with your systems. The other thing it does is as you are pulling the information, it allows you to have a real-time view of what the score is going to look like for potential home buyers as this transition occurs. Some scores are going to be higher, some scores are going to be lower, and people whom you thought would be eligible for a loan under the current environment may not be later, or vice versa, but you would want to be able to understand that. And having that level of understanding, along with making sure your systems are operational, will get you prepared for day one. The other thing that we've been telling people, especially if you have a non-conforming portfolio of loans and a special purpose credit program out there, some of which don't require a credit score at this point, but maybe you want to monitor how the market is seeing them or what their performance looks like with the VantageScore, to work with your credit score provider to have them appended to an existing portfolio and then refreshed over time so that you can see how the VantageScore will change over time for existing customers. Again, that gives you a better understanding of how the credit score will work and what it means for the systems that you have out there. And then the third thing is if you have a larger data set of historical information, because you're doing some level of risk analysis or risk assessment, to take a portion of that or all of it and have the score, VantageScore 4.0 appended so that you can begin right now adjusting your models so that when day one occurs, your shop is already prepared for the changes that are going to occur. Over the next two slides, I'm just going to show you what that would look like from an operational standpoint, to be quite honest. The first one is just if you have an existing mortgage portfolio. It could be HELOCs, it could be, like I said, a special purpose credit program, or any product that you have out there. You would be able to take those loans and have your credit score provider pull through a VantageScore and append them to your existing portfolio so that you could begin to monitor now and understand in real time now what the performance for your portfolio would look like using VantageScore 4.0. The second opportunity, and that is on the origination side. So as you are originating, as you have customers coming into your shop to originate a mortgage, you would pull at origination a VantageScore just for the purposes of monitoring and seeing, one, can I get that into my system? Can I have it refreshed as we are moving through this process, and to gain some practical knowledge about how that score will operate against the marketplace. Those are the models or the pilots that we are suggesting, and we would love to talk with you about potentially implementing one or both of those models in your shop. So after this is over, please feel free to reach out to me, reach out to Owen, VantageScore, and let us know if you are interested in that. Before we go to quick questions and answers, I'm going to pass this back to Owen.
Before we move on to questions, I've launched a 2-question poll. First, asking you to rate the usefulness of the content, and second, asking for any feedback on what you liked or disliked about the webinar. Also, if you'd like to speak to us one-to-one, you can also leave a message there and we'll reach out to arrange something. If you could please fill that out, that'll help us shape our future updates to be as useful as possible. Okay, the first question I have is, for those of us that work with the federal home loan banks, how best to engage with them for a potential pilot program?
That's a great question. So the first thing I would say is to contact your federal home loan bank and ask them about their implementation process for the new credit score model, in particular VantageScore 4.0. We've reached out to all of them about this. I know that there are a couple that currently accept VantageScore 4.0 for collateral that's being provided, but for the folks that are actually purchasing loans, you should talk to your program provider, your mortgage program provider at the Federal Home Loan Bank, and indicate that you would like to have a quote unquote sandbox possibly to work in. And we can then work with that Federal Home Loan Bank and you to establish that so that you can begin to get information on VantageScore 4.0 and the loans that you're going to be bringing in.
Okay, perfect. I have another question. What types of data is offered by VantageScore off the shelf if we want to track score performance trends?
So we do have, and that's another good question, and I'll have to add that to our next presentation, but we have a product called Risk Ratio. You can go out to VantageScore.com right now, go to our data tools page, and you Risk Ratio. It will allow you to take a look at performance by credit brands for different years of performance. You can compare them to VantageScore 3. You can compare them to, or you can take a look at VantageScore 4 for this year, for last year, and you can look at them for products, mortgage, credit card, personal loans, auto loans. So there is a tool out there. I would say it's pretty robust. You can go and play with it right now, and it's free.
Okay, perfect. One question I have is, will we receive a copy of this recording? And I can answer that. So yes, we'll be putting it on our website. So we can send an email out to all participants with a link to it once it's loaded up onto the site, and you can share it with any of your colleagues who are interested in seeing how it's gone. I do have another message from someone interested in the pilot program, so I'll pass that over to Tony, and we can get in touch with you later. And I don't have any more questions, so I think with that, looks like we can wrap up. So thank you for joining. I hope you found it informative. And as I mentioned, it'll be on the website, and we'll send an email out as soon as that's up. If you have any further questions, you can email Tony at VantageScore.com, or you can email myself at Owen@VantageScore.com. So thank you very much for attending.
Thank you all.
Thank you.